Annuities sit at the crossroads between insurance and investment. They're contracts, but they behave like securities. They promise income, but they carry risk. And on the Series 7, they're a test of how well you understand both. At their core, annuities are designed to provide income for life, a stream of payments that continues as long as the contract holder, called the annuitant, is alive. An investor buys an annuity from an insurance company, either in a lump sum or through a series of payments. That money grows inside the contract, tax deferred, until the investor begins withdrawing it or annuitizing. There are two broad types: fixed annuities and variable annuities. In a fixed annuity, the insurance company guarantees both the rate of return and the payment amount. The insurer assumes all investment risk. The investor's account grows at a fixed rate, and when it's time to take income, the payments are predictable. But that safety has a cost. Fixed annuities can lose purchasing power over time because the payments don't rise with inflation. A variable annuity works differently. Here, the investor's money goes into a separate account, not the insurer's general account. That separate account is divided into sub-accounts that function much like mutual funds, invested in stocks, bonds, or money markets, depending on the investor's choice. The investor, not the insurer, assumes the investment risk. The performance of the separate account determines how the value of the contract grows and what future payments may look like. Variable annuities require both a prospectus and a securities registration because they're considered securities as well as insurance products. The representative who sells them must be licensed for both, with a securities registration such as the Series 6 or 7 and a state insurance license. Variable annuities have two distinct phases. The first is the accumulation phase, when the investor contributes money and allows it to grow. Earnings accumulate on a tax-deferred basis. During this phase, the investor can switch between sub-accounts without triggering a taxable event. The second is the annuitization phase, when the investor converts the account into a stream of income. Once annuitized, the payments begin, and the contract's value becomes an obligation of the insurer. When those payments are made, they're partly taxable and partly tax-free. The taxable portion represents the earnings that grew tax-deferred. The tax-free portion represents the investor's original cost basis, the money they contributed with after-tax dollars. For example, if an investor contributed $100,000 and the account grew to $150,000, 1/3 of each payment would be considered a return of principal, and 2/3 would be taxable income. Variable annuities include several optional guarantees, called riders. The death benefit guarantees that if the annuitant dies before annuitizing, the beneficiary will receive at least the original amount invested, regardless of market performance. The guaranteed minimum income benefit promises a minimum level of income regardless of how poorly the separate account performs. And some contracts include living benefits that lock in higher payout bases if the account reaches certain milestones, even if the market later declines. Each rider adds cost, and that's reflected in the annual expense ratio. When the contract is annuitized, the insurer uses an annuity unit to determine payments. During accumulation, the investor owns accumulation units, each representing a share of ownership in the separate account. When the contract is converted to income, those accumulation units become annuity units. The number of annuity units is fixed at that point, but the value of each unit fluctuates with the performance of the separate account. If the separate account outperforms the assumed interest rate used by the insurer, known as the AIR, the annuitant's payments increase. If the separate account underperforms the AR, payments decrease. So while the number of annuity units stays the same, their dollar value rises and falls based on investment performance. Variable annuities can be tailored in how long they pay. A life annuity pays income for as long as the annuitant lives, but nothing to beneficiaries after death. It provides the highest payment amount because the insurer bears the risk of the unknown lifespan. A life with period certain option guarantees payments for life, but also for a minimum period, say 10 or 20 years. If the annuitant dies early, the remaining payments go to a beneficiary. A joint and last survivor annuity covers 2 lives, often spouses, and continues paying until both have passed. The payments are smaller, but the coverage lasts longer. A unit refund annuity guarantees that if the total payments received are less than the initial investment, the difference is paid to a beneficiary after death. Each option balances the trade off between payment size and security for heirs. From a suitability perspective, variable annuities are long term products. They're meant for investors who have maxed out other tax advantaged accounts like IRAs or 401ks, who are comfortable with market risk, and who want lifetime income. They're not suitable for short term goals or for elderly investors needing liquidity. Withdrawals before age 59 and a half are subject to a 10% penalty on earnings, just like IRAs. And while contributions aren't limited by annual caps, they're made with after tax dollars, meaning only the earnings are tax deferred, not tax free. For comparisons, fixed annuities suit investors who want guaranteed income and minimal risk. Variable annuities suit those seeking growth potential and inflation protection through market exposure. One more comparison between variable annuities and variable life insurance. Both use separate accounts for investment, and both require securities registration. But their purpose differs. A variable life policy is designed primarily for death benefit protection, with investment growth as a secondary feature. Premiums are fixed, and if the separate account performs poorly, the policyholder may need to add money to keep it in force. A variable annuity is designed primarily for retirement income. It's funded with either a lump sum or flexible premiums, and the goal is to convert that balance into future payments. In both cases, the separate account gives the policyholder market exposure, and with it, the risk and potential of market returns. When you look at variable contracts, the pattern is always the same. The more risk the investor takes on, the greater the potential reward, and the greater the need to understand what's guaranteed and what isn't. The insurance company guarantees the structure, the math, the mortality tables, the right to income for life. But it does not guarantee the value of the separate account or the amount of each variable payment. That's the investor's domain, the place where risk and reward meet in the market itself. In the end, variable annuities are an attempt to balance security and growth, to take the fixed promise of insurance and let it breathe in the open air of the market. They remind us that investing is always a conversation between certainty and possibility, and the smartest investors are the ones who know how to listen to both.